R Srinivasan, CIO with SBI Mutual Fund joins us now. It's the first time I'm interacting with him, at least on this forum. So Srini, good morning. Thank you for joining us. I'm I'm so happy that finally you've agreed to find time to join us and talk about your thoughts and where you think markets and your funds are headed. I want to start first with the big picture. And the big picture is that for a market where 3 months ago we were struggling to find a fault line, suddenly a lot of cracks are opening up. Cracks on the macro front, cracks on the commodity front, and also cracks which are coming up, at least on the interest rate and inflation side.
Okay. So what's the question? Sorry.
Go from here, looking at the cracks which are coming up now. Do you think somewhere now we are about to hit a pause button?
Quite possible here. I think there is a narrative and then there are markets. The narrative was always weak. I guess sometimes we get confused the other way around. So the markets was, the momentum in the markets was very strong. And we started painting narratives on growth, on rates. But the risk was always there. You look around, things aren't so great. Things weren't so great. So I guess the markets have run up quite a bit and they're coming off. And it's still been a fantastic year. Yeah. It's still, I mean, investors are making crazy returns, especially down the market cap curve. So I'm not surprised. You shouldn't be.
So the question is, how much of the underlying gains will sustain? And based on what we've heard from companies, along with their quarterly numbers on the forward-looking commentary, there is reason to be realistic, or there is reason to be optimistic?
No, there's definitely reason to be optimistic. So when you look at valuations, right? Valuations are not. There's a single variable doesn't define valuations. Valuations are a function of growth. Valuations are a function of cost of equity. They're a function of return on capital. The last part is kind of correlated to both growth and cost of equity. So the narrative on growth is positive, meaningfully positive. In fact, growth in this, it's quite ironic. If you look at the growth between, say, FY22 expectation vis-a-vis FY19, which is a pre-COVID year, this is the highest growth that we've seen in many years, right? I wouldn't have expected it once COVID, at least when, COVID happened. So the narrative on earnings is positive, and then you have these schemes that the government has introduced, which gives a boost to the Capex cycle, a much easier fiscal and monetary policy. So the narrative on earnings is positive. You've got the aspect of cost of equity, which is also positive because rates have gone down. Now, the real question to ask is how much of that earnings growth is sustainable and how much of this fall in yields is sustainable? Will yields go up again? So it's a little complicated to answer that question in terms of, so are markets expensive? Yes. Should they correct? Yes. How much will they correct? At what level should you start buying? For that, you need to answer what is the sustainability of growth? What is the sustainability of this interest rate environment? What is the probability of some external shock hitting the currency and impacting rates or inflation for that matter? So it's a little more complicated to arrive at the level of the market at which you'll start buying.
Can you broadly walk us through pockets where excesses are built up? There is more storytelling, in your word, narratives are strong, but the underlying current of earnings is not strong, or valuations are super stretched, and a pocket or a few ideas where you think that markets will be positively surprised as they have been in case of a lot of companies.
As in sectors or themes?
Let's talk about themes because with sectors the problem, Srini, you know it more than me, that you cannot have a generalized approach.
Right. So that's true with themes. So I don't know how themes are not really homogeneous here. So I don't know how to think about this. So the IPO, the primary market theme, for example, is definitely overheated. But is primary market one homogeneous theme? Maybe it is because you have retail flows driving primary market issuances and the money that you make on listing. But these are all different companies at different points in time, and market has also been making a bit of a distinction there. Then you have this whole technology team outside IT services, the whole uh, internet space, the disrupting space. That's a theme where I see people getting very excited. I've heard terms like valuation agnostic, which is so ridiculous. But that's a theme that's getting heated up, possibly because this is a theme that's worked very well in developed markets, and there is this whole China thing that's happening that's probably driving investors from China to India looking at this as the next big opportunity. That's probably a bit homogeneous, but it's still all over the place. I mean, you still got to distinguish between companies that are really in that space and companies that just say that they are in that space. So I guess these are two obvious themes that seem exuberant right now. I can't think of any right away.
Hi, Mr. Srinivasan. This is Mubina as well joining in. Firstly, how do you read into the commentary coming in from the US? Many people said that this bull run that we have seen, in the markets is primarily on account of this massive surge in liquidity. Now, if the US comes and says that, okay, listen, we are ready to pull the plug, of course, not all at once, but, slowly and steadily, starting as early as perhaps next month, is this something that could spook us? And my second question is, do you think that, we're seeing, unfortunately, a resurgence in cases in China, in the US as well, in pockets here and there. Could that sort of, ensure that central banks postpone their hawkish stance or their slightly more conservative monetary policies?
See, it's a weird world here. We kind of keep coming back. I think effectively what you're talking about is the whole tapering thing, right? Now, people in this financial world have screwed up English also. Taper means something that goes down in width. I think we talked about taper close to 10 years back. We're again talking about taper. So I think there is being this belief in the markets, especially the US markets, that the central banks they can do whatever they want. They can keep printing money, and the markets, and they can manage the whole dilemma around inflation and growth, and keep this running. I think somewhere they call it the modern monetary policy theory. But I don't know. Yeah, we should definitely be worried about it. It does, right? Is this the time when central banks lose their ability to do whatever they've been doing all these years? I'm not so sure. In fact, there's a very interesting comment. Let me think what exactly this guy wrote. So this is guy Rahul, who works on the sell side, and he sent me this comment. If you think about it philosophically or technically or conceptually or whatever, can you really owe money in a currency that you alone have the right or the legal authority to print, which is exactly what is happening in the US. They print money and there's nothing all of us can do about it. So will that run continue? I don't know. Is it risky? Definitely, very risky. And these are uncharted territories. I would be really worried because I'm old school, I guess.
No, of course, fair enough. The other point that we've been talking about, that look, the market breadth is going to get really narrow. You'll have to be very picky, very selective of what you buy from your own. If that's the case, of course, your job becomes even more important, even if not, if it not already was. So in such a situation, looking at where we are, and like you mentioned, it's a very weird and uncertain world. What would you look at then when you go stock picking, when you include stocks for some of the SBI funds?
Okay, let me admit here, our job is much easier, right? We are relative return investors. We just need to outperform the benchmark. We're not really, so the questions that you are asking, I really don't have to think about them beyond a point, because if the market falls, I will also fall. I just need to outperform. So from that perspective, it's relatively easier. And that's been a big deal, because with this kind of a view, I would have got screwed completely. Now, coming to stock selection, yes, that's what we've done here all these years. And we have a large team, and we just focus on trying to figure whether the business that we're buying is a good business, and we keep evaluating that on a constant basis. A good business, again, is a business that is defined by competitive advantages, return on capital, growth, the longevity of growth. We evaluate the management in terms of track record, and obviously we're kind of connecting the whole investment thesis to what kind of price we pay. I guess you keep doing that, and the sources of alpha, it will change depending on the momentum in the market, but it kind of keeps active investing relevant, kind of whatever.
Hi, Mr. Srinivasan. At one point, of course, you said you're old school, but you're also talking about finding the new age, the transformers, if I could call them that. So, in recent times, when you're doing this stock picking and looking at the sectors, what are the new pockets that you have found that are interesting that could give you the kind of returns that you're seeking?
Well, right now, I'm short of ideas, to be very honest. We're running a defensive portfolios. The stocks that we like, they are pretty expensive. And the kind of assumptions that we need to make in terms of extending the high growth period or attributing significant market share gains and returns on capital sustaining at higher levels, these are assumptions you're not really comfortable with. So let's, I shouldn't name stocks, I guess. It's easier when you talk stocks. So the names that we like are expensive. And the high growth pockets, for example, that are coming in, which are very interesting in terms of the disruption, they are crazy in terms of what they're looking for. So there isn't an easy answer to it. It is easier for me to answer these questions in terms of stocks that I like, but unfortunately, I think there is this gray line in terms of what I can speak in terms of specific stocks. So I'm sorry, I don't know how to answer that question.
We should avoid talking
there are
stocks.
no
What we can do is that we can
teams.
put a declared portfolio out. We can put a declared portfolio out, which in a sense is an indication of what your thoughts are. So let's talk about 2 or 3 sectors, one which is full of excitement, other which is full of stress, and that's pharmaceutical. Same time last year, everybody wanted to buy a pharma stock because everyone thought pharma would benefit because of COVID. Right now, nobody wants to buy a pharma stock because prices have collapsed and generic issues are there. Is this a stress? Is this a good time to buy the stress into pharma, or there is a structural issue with pharma pricing in the generic business like we saw between 2016 and 18 or 15 and 17?
So I think that issue was abated in pharma. So that issue is there and will remain, but it is abated. And I think it's a very interesting sector to look at. One, because of what I mentioned right now, that these issues, whether it was consolidation on the US front and these generic pricing issues, they've kind of abated. A lot of it has already happened. Second, if you look at pharma as a sector, it's really not performed pre-COVID for a pretty long time. So what you saw into this rally, or the initial part of the rally, was pharma catching up on the earlier underperformance effectively. And I think this whole crisis has kind of given a boost to pharma, especially in a different space. I mean, the stocks that we've owned for a very long time, like DVs and Gland, again, I'm talking stocks, but these are holdings. These are businesses where you've seen very significant momentum. I'm not talking about the stock price. These are businesses where we've seen substantial profit growth, way above what we were expecting in our wildest imagination. And these companies are now investing big time. You look at the Capex plans, they're investing big time, and companies invest if they see visibility of growth. And even the probability of that visibility is now much, much higher because of this whole China plus one thing in APIs or intermediates or specialty chemicals. I think it's a sector that's very interesting. You will have obviously stocks that will have those specific issues that they faced in the last 5 years pre-COVID. So I guess we have these stocks that we like, and on the larger funds, we are still playing this basket. I'm not sure how effective this basket will be. It's worked so well for us. It's worked well for us, I would say. And it's a little, I would also think that the whole compliance around the pharma companies, the requirement may not have come down, but we've learned, and the pace at which you've come out with this vaccine, the mRNA, for example, is not even tested on humans. It kind of tells the world's, I mean, they're okay with, going ahead since this is kind of the need of the hour. I don't know whether that should lead to a re-rating, but that's something to think about, I guess.
Okay. In next 3 to 5 years, do you think a basket of traditional consumer companies, which is HUL, Nestle, Britannia, that will outperform, or a basket of new tech consumer companies, whenever the basket is ready, starting with Zomato, Policybazaar, Nykaa and others, that will outperform?
Oh, that's a very interesting question that you ask. And we've kind of debated this question. I thought it was exclusive to us. But I don't like consumer companies like Lever and Nestle because they're quite expensive. I don't mind paying if there is growth, right? And growth in these segments have kind of saturated. They are still single digits, somewhere higher single digits. But if you want 15% returns, these are not companies which can re-rate from there. So this is an interesting proposition, right? You shift to other expensive names where there is growth. Now, the problem there is, how do you think about valuations? In Lever, at least I know Lever is trading at 70 times or whatever. And Nestle is trading at X multiple. These are companies that are losing money. And when I think about valuations, I got to think about valuations in terms of the sustainable profits that they will make. And I will obviously pay a significant premium because of the growth that is happening on account of the disruption from offline to online. But a very important aspect you need to figure out is whether these businesses have competitive advantage, whether they will sustain and actually start making this money. Once they start making money, will they be able to continue making that money? And what will define them making this kind of an annuity is effectively the competitive advantage. Why does Lever make money? Lever makes, I guess, the infinite return on detergents, for example, or soaps, because you buy a brand and you pay a premium for it. That premium gives you the entire profitability. Now, do these businesses have that? Can somebody else come and disrupt the existing disruptor? I think these are very relevant questions, and these are very stock specific. So a lot of these new businesses that are coming up, I'm extremely skeptical about. And I'm actually, I feel good when we reject some of these, because it just doesn't feel comfortable. But it's again very stock specific in terms of what you want to buy. Okay. I wouldn't play this as a theme for sure. I wouldn't just switch from the consumption or the consumer staple basket you're talking about to new age companies as a theme without being stock specific on the underlying business and the competitive advantage.
Great answer. Let's wrap it up, and let's wrap it up with the other important exciting part which is there in the market. Some are liking ethanol related companies, which your fund has bought in the past also. Some are bullish about what is happening on the EV business. Some are excited about ESG. How much of these buzzwords, whether it is clean fuel, clean energy, ESG, how much of that is hot air and how much of that is the realistic, where you need to be more forward looking and forward thinking and accept that these are the sunrise high growth sectors of this decade?
Let me answer this question differently. So we run this fund, focused fund, right? If you kind of look at the profile of that fund, the stocks that we own, the stocks that we've owned in the last, say, 7-10 years, this is the most ESG compatible fund that you will see. But it's not called an ESG fund. E is a very inherent aspect of figuring out how to assess a business. What does E mean? If there is environmental disruption, it will lead to that business shutting down effectively. So if you look at something like thermal power or two-wheelers in this era, right? These businesses are getting disrupted, which means the money that they're making, they will no longer make beyond a point. And you have to be worried about that. Should you buy these businesses? You shouldn't. Why shouldn't you buy these businesses? Because you cannot pay into an annuity stream. Even so, if you give to give you a simple example, a business that gives you an annuity stream, even if you apply 10% cost of equity, which is pretty low, you give it 10 times multiple, right? You don't give it 30, 40 times multiple. And if this annuity stream itself is going to stop and go down, what is the multiple? It's got to be lower than 10, right? It's a very inherent part of assessing a business model. So, but there is an E there, which is the environment, which is also a little beyond what I'm talking. And then there is this G part. G is always governance. It has always been a very inherent, intrinsic part of our stock selection process. We have a forensic model, for example, which runs some 16 variables across some 600, 650 odd companies. And our analysts, for example, discuss each of the red flags, and we kind of question and figure out why that is so, whether it is miscellaneous expenses as a percentage of sales or it is the auditors. So G was always a part here. This is not something new, but ESG definitely is a buzzword. But I think S is something which is still evolving, I guess. It relates to, I guess, gender diversity among other stuff. But these are issues that as investors, we always thought about. Now there is a term to it. And I guess that's good. Yeah, the philosophy kind of the philosophy that you should logically apply to stock selection becomes mainstream if it does. So I guess you got to they are buzzwords, but a lot of them have been relevant for a very long time. They just weren't called such. I mean, I'm talking of ESG. I forget the other stuff that you talked about.
He talked about EVs as well as ethanol.
Those are cyclical themes that keep coming up, right? You got to obviously look at businesses which will make money out of it. And, I mean, that's very specific to a sector and kind of thematic or cyclical.
Okay. With that, I'd like to thank you for taking the time out and for joining us live here on the market. As Nikunj was saying, it took some persuading to get you here. So look forward to more interviews.
Thanks. It's a pleasure.